Bring in Jeremy Bryan, Senior Portfolio Manager with Gradient Investment. Higher, faster, longer. It sounds like the Olympic motto, Jeremy. Do you agree that that's what we're looking at? And if so, how can that be good for stocks?
Yeah, I mean, maybe a little bit more, but I mean, I don't think today's testimony was a dramatic shift of where he's been before. You know, from that perspective is our base case hasn't really changed much. Maybe another 25 basis points at this point going forward. You know, I think the bigger concern.
Excuse me, just let me interrupt because I think perhaps there are people in the audience and in the investment business who now say a half point is back on the table for March, and a half point maybe again.
Entirely possible. Entirely possible. I mean, you know, so his, you know, the bearish commentary or the, you know, the more difficult commentary from that perspective is possible. But I mean, the probabilities are going up. But from our perspective, I mean, the worry is that he goes too far, too fast. And that is certainly a concern out there. But I don't think this was a dramatic shift. I mean, he was in front of Congress and had to give what they've seen as the case. And it may go slightly higher. And the probabilities are going up on the assessments of that. But I really don't think this was a dramatic change in pace from what we've seen from him for the past couple of months. And so we're going to monitor, you know, the more important thing for us is honestly the data that's going to come out in the next week and a half. Is we're going to have a jobs report and we're going to have a CPI report. That's where the rubber meets the road on this. And that, you know, if those are adjusting and going the wrong direction, then yeah, we may have to pivot our base case to go for higher rates in the future.
You know, Bob, at the same time, I think that Gina Sanchez did give voice to what a lot of people seem to be thinking post Powell, which is to say he didn't even try to really hint at anything like, you know, maybe January was just hot and you know, disinflation's still underway. And I mean, he basically just took the numbers and ran with them. And maybe he's spooked by the fact that the bond market's inflation expectations have backed up a little bit. I mean, that's an important point in all of this is that the market itself is thinking inflation looks hotter now than it did just 6 weeks ago. And maybe, Bob, the Fed feels like they have to respond to that.
Yeah, I agree. He's not spooked by the bond market. He's spooked by the data. This is where I slightly disagree with Jeremy. The point he kept making today is inflation is much more persistently remaining higher than we had anticipated. And so we have no choice. We have two mandates. We got to keep the job market strong and we got to fight inflation. Job market strong. Therefore, we really got to fight inflation. And we don't have any other instruments other than essentially to keep raising interest rates. So I think the message essentially from him here was slightly different in that he kept insisting we're going to have to keep going here. And that's what the market kept hearing here in the middle of the day. Remember, the market's levitated itself into believing the soft landing is a reality. And that means, well, we're going to stop at a certain point. And now the data is not supporting that. We see that. Everyone sees what the inflation data was, even including last week's PCE report. Powell sees it, too. And now he's simply saying what I think the facts are telling us right now.
Jeremy, quick thoughts on a couple of stocks that you like. They have been slightly, I guess, sort of problem children recently. Johnson & Johnson, one of them, Nextera, and maybe even Google.
Yeah, I can give you all of these. And the effect of the first two probably work in an environment where rates are rising, right? Is that the insurance names from that perspective were very good last year. And then when we had this reversion of everything that worked poorly last year has worked well and vice versa,